Okay, now this is gonna be financial accounting. Now, in the financial accounting, if I talk about the exam format, we are going to have the section A over here. The section A is going to have 35 questions of 2 marks each. That's going to be 70. Then we have section B, in which we are going to have 2 questions of 15 marks each. That's going to be 30. And total is going to be 100 marks paper, right? This is going to be a 100 marks paper. Now, these 2 questions, I mean, if I talk about these 2 questions, these are sort of, they can be MTQs, comma, structured based, but on a pre-given format, right? It can be the MTQs multitask questions over here. 3, 4 requirements or 5 requirements are given to you within a given scenario, and you have to act accordingly. So most probably these are, most probably not, but mostly these are the MTQs, right? Where you are going to have 3, 4, 5 scenarios related to which we have to approach. And normally I cannot assign the number over here for the MTQs equally. At times we have 4 requirements, at times we have 5 requirements, at times we have 3 requirements only, but mostly it is the 4 requirements, okay? And one of the requirements, the bigger one, is for like around 6 marks. Then one is for 2 marks, one is for the 2 marks, or one is for the 1 mark. I mean, you get if like, around 4 requirements or something now, right? So that is the MTQ kind of based questions over here, right? Or they can be a structured based question where you have to draft your answer, like making the basics of the consolidation or the basics of the final accounts or something, naming the income statement or the statement of the financial position over here. But the format is going to be given to you, and the examiner is going to ask to fill it up, right? The format is going to be there, and he's just going to ask that you have to put in the figures right in front of the boxes which are going to be given to you over there, right? So we are going to practice such questions over here as well. These questions are going to be attempted once we are done with the proper comprehensive coverage of the syllabus. Then we are going to go with the section B. Obviously at start we are going to gradually start and gradually learn with the pace and the basics, and then we'll move forward towards the trickier topics and the examiner's favorite topics which are going to be there, right? So in the first 1 2 lectures, or first 2 3 lectures rather, I will be building up the foundation, because this whole big building, right? This, the big building, you can say, of the accounting, it needs to have the solid foundation, which I am going to start to create and build right from today, right? So in start, we'll be steady with a particular pace. I won't rush the things. I won't push you, but I will to some extent, but I will not push you to the extent where I feel like that you will be overwhelmed with the information over here. So I will be steady with the pace, right? Okay, I'm back. Surprisingly, I got disconnected. Don't know why. So I was saying that to start on it, right? So we'll move with a gradual pace and all. Okay, now Moving ahead from here, if we talk about overall speaking, the first thing that we have, there are certain terms which we have to talk about before moving on to the, the financial accounting and all. We have a term being called as the business. If we talk about the business, business is any activity carried out with the intention to create profit. So business is any activity carried out with the intention to create profit. We have types of business. If we talk about as far as the types of the business are concerned, we have this sole trader, partnership, and company. Right? Now, first one is sole trader. This sole trader is an individual carrying out the business, right? A sole trader is the one who's an individual, a single one man, right, who is carrying out a business, right? Now, the advantages of being a sole trader, if I talk about, that is, you get to have the control, flexibility, and then obviously you have lesser business formalities, right? Because you are the one who's the owner, you are the one who's managing and running in the business and all and everything, now. So you are flexible enough, you have your own control onto the whole business as well. And similarly, there are lesser business formalities which you have to follow and all, right? Then we have certain disadvantages as well. Now, if I talk about as far as the disadvantage is we as a sole trader have a unlimited liability, right? Unlimited liability means that if our business fails or something, we are going to liable for that, and then obviously we will have to uh, fulfill, or we will have to compensate for the loss, or we will have to pay off the liabilities of the business, whatever they are, from our own pocket as well, right? And then as far as the raising finance is concerned, this can be trickier over here for the sole trader, because if you are running as a one-man show, or you don't have a big business or something, so at times raising finance, it can be very concerning as well, and it can get difficult for you to raise the finance, right, or to arrange the finance. And obviously, if you're running the business, obviously, if you are short on funds or something, obviously, you won't be able to spend much which you want to in actual onto your own business as well. And then obviously, the business continuity, that is something in danger as well, because if you suffer some losses or something, there is a possibility that you are already short on finance, and then if you suffer some loss or something, then obviously the continuing or keep going with as far as the business is concerned, it might not be possible as well, right? Then after the sole trader, we have the partnership with us. Now, partnership is that two or more persons working together to earn profit. Maximum members in a partnership can be 20. If you go above this, then you have to create a company, right? The advantages which we normally get in the partnership are get to have defined roles. You get to have the easy raising finance is concerned, because you are multiple partners. Say in case if you have to raise 100,000, and if you are working as a sole trader, na, it's unable, or you are not able to take out the 100,000, all of the amount by your own self now. So if you are in the partnership and you guys are three, four partners, everyone will be contributing only 25,000 towards a total of 100,000. So arranging 25,000 by an individual is way more easier comparatively, in comparison to the 100,000 that he has to raise or arrange, right? So raising finance or getting the extra pool of finance is kind of easier, right? And then obviously, the advantage is we are going to have some paperwork over here. Everything is on paper. The agreement between the partners is on paper, so everything is written and clear. So it's formal as well, right? So it's a advantage, that everyone knows about their role and everyone is working together towards the betterment of the business. Similarly, you are going to have the skills and knowledge over here as well, because this is going to be a synergy effect. 1 plus 1 is going to be 11 over here, because if you're working alone, you are alone, but if you're working with a partner, you are in bigger and better position to have a spurt, pool of knowledge and the skills and expertise as well, right? So it's going to be easier for you to manage and all. Similarly, if we talk about as far as the partnership is concerned, the risks are shared as well. At first, the sole trader has to bear all the risk or something, na? So while being in the partnership, the risks are shared. So it gets easier for you to manage the stuff as well, right? And then, like the advantages, you have some disadvantages as well. Now, talking about the disadvantages, I mean, if we talk about the first disadvantage, which I always feel, is the profit sharing. The partners can have some serious disputes as well, right? And then obviously the costs can be high as well. Like, say, in case if a partner takes a wrong decision, if a partner takes or ends up taking a wrong decision, then it's possible that you might have to suffer the cost because of that wrong decision as well, or you might have to suffer, because of the wrong decision being taken by the partner as well. Obviously, because you cannot back off or you cannot back down as far as the decision which has been taken by your partner. Now you have to honor the commitment even if it's wrong as well. But again, the wrong decision taken by a partner, you will have to suffer as well, right? And then after the partnership, we have this company over here. If we talk about the company is going to be limited liability company over here, right? And a limited liability company is where the investors invest in the company by buying shares, right? And becoming the shareholders, right? So companies where basically the investors, they are buying the shares, they are becoming the shareholders, right? Now, the advantages. Advantages are basically that you are going to have limited liability. You are only going to be liable up to the amount that you have invested in the company. Like, for example, if you have bought the shares and tomorrow, if the company goes into the liquidation or company goes bankrupt, you are not going to be responsible to pay out the company's debts from your pocket. You are only liable for the amount that you had already invested in the company. So nobody is going to come to you to collect the debt which the company has to pay. Unlike the company, if you are running a business as a sole trader, And if, say, in case your business goes into the liquidation, then you have to bear and complete and honor all of the liabilities from your own pocket as well. I mean, in the case of the bankruptcy of a sole trader business, huh, you have to complete and you have to pay everything from your pocket. But in company, this is the advantage of the company. If you make up or you make a formation in the company, that nobody's going to come to you to collect the debt that you are, like, that the company has to pay or something, right? You are only going to be responsible up to the amount that you have already invested, and that is something which is already over there. So nobody's going to ask from you for the extra or something, right? Raising finance, that is relatively easy and easier over here in the company, right? And then obviously the business continuation is something that's going to be insured over here as well. Why? Because you have the managers, you have the directors who are working, and everybody is expert in their field. So technically speaking, if you are there or you are not there, some, like, or if a person leaves, if a person comes, and God forbid, if somebody dies as well, the company will keep on continue to work, right? So the business continuation is kind of like, sort of insured over here. That will continue to go like this, and everyone, apart from the everyone, I mean, the business is going to be running, right? So that is a advantage, one of the advantages for, as far as being a company is concerned. Then the disadvantage is, the cost, the taxation. The cost for the formation of company is really very high. Obviously, you need to have a big office. You are going to incur lots of costs because you are going to employ lots of people to work for you, right? And similarly, the corporation tax or the companies, they do pay the tax as well, no? So the tax on the profits is going to be higher as well, right? So these are the costs that ultimately that you have to pay. Now, if we talk about the accounting, accounting is normally done for the businesses. It can be the sole trader, it can be the partnership, it can be the company as well, right? So the accounting is basically done. Accounting is basically keeping the track record of what is happening financially. Now that is what the accounting is, right? I mean, if somebody asks that what is accounting, we normally say that accounting is basically keeping a track record or keeping a financial track record or keeping a track record of what we are doing or what is happening, right? Or apart from that, if somebody asks that what is accounting, so we can easily say that it is the recording, summarizing, and presentation. What is accounting? It is the recording, summarizing, and presentation. This is what basically the accounting is. Done? Now, if I talk about the accounting overall speaking, we have two types of accounting. One is called as financial accounting. One is called as management accounting. Financial accounting is something which is used to communicate outside the organization, right? That is something where we have summarized information. That is something where we have set pattern and accounting standards. That is something, I mean, if we talk about from the accounting point of view, that is something which is prepared at least annually, right? That is something which is generally required by law. Financial accounting is something which reflects the past performance of the business or the company, right? It reflects the past position of the business as well, right? That is what the financial accounting is. Whereas management accounting is used to communicate, used for communication. I mean, we can say it as used for in-house communication, detailed information, no set pattern or accounting standards. And then if we talk about can be prepared weekly, monthly, quarterly, or annually, right? Not required by law, can have past or future forecast and results as well. This is what basically the management accounting is, right? Okay. Now, this is the FA paper is the financial accounting. So our primary focus over here is going to be on this area, right? Over here in the financial accounting, this is what we use to communicate outside the organization in a summarized form with a set pattern and accounting standards, right? Now, in order to communicate outside the organization, I mean, if we have to talk about our performance or the position, we simply say that at the end of the year, what is the profit which we have earned? What is the total amount of sales that we did in the year? What was the cost? And what is the total profit that we have earned? Right? Now, we have a set pattern to report our sales figure, to report our cost, and to report our profit as well. We have a set standard which we follow for the presentation. We have a rule to follow what we are doing or how we are doing, right? Now, why do we have to go for the summary in a summarized form? And why do we have to follow a set pattern? When we ask this question, like the way we had a formal introduction, like, over here with each other today, right? Now, in the formal introduction, we just said what we have done, right? And what we are doing and what paper we are studying, right? We don't have to go into the details outside, I mean, outside the organization or outside ourselves. That is, say in case if you guys studied the A levels or if you guys have done BS, I did not ask you to show me your transcript. I did not ask you to show me how many numbers you got when you took the admission, what subjects you read, and what subjects you were good, and what subjects you were okay, and which subjects you hated the most, right? Where you go, when you go, or how you go, right? These are the detailed things. Now, these are not required to be communicated outside the organization. Similarly, for the business, I mean, it's useless to talk about what we do or how we do. Because outside the organization, there can be some layman as well from for whom this information is useless, or there can be market competitors as well to whom we don't want to leak our data. Third, say in case if I have invested money in some companies, I'm least concerned what they do or how to do. I'm concerned what the return they are offering me, right? I'm just concerned with the return they are offering me. Done? And when I talk about the set pattern or the accounting standard, the information or the financial information which we are presenting outside that how many sales we had for the year, what was the cost for the year, and what is the profit for the year. Now, if everyone starts calculating the sales or the cost or the profit by their own way or by their own will, they are going to make up the the records, and they are going to make up the results or the information which is always going to be accurate, which is always going to be in the best way, which is always going to be something which is you know uh favorable to them or something. right? They are always going to present the picture in this way. Now, I mean, if it's like, always on you to report about your performance, if it's always on you, let's say not on you, but on me. If it's always on me that I have to report my performance, will I ever report that my performance is bad or something? Like, if I'm working in the office and at some days, if I don't feel like doing the work or something, will I tell my boss, will I tell my senior that I don't feel like working today? Huh? Obviously we cannot now, because we think that it might not be appropriate to tell about this information now, right? So we need to have a set pattern and standard via which, when the reporting is done, it's reliable. When the reporting is done via following the accounting standards or something, it's going to be reliable. Secondly, by having a hard and fast rule of following a format or an accounting standard, it makes the comparison easy for the financial accounting as well. It makes the comparison easy of the accounts as well. Like, for example, if I'm sitting in Pakistan and if I have to do the business with one of the Mauritian company, or if you guys in the Mauritius and you have to do the business with one of the companies in Pakistan, or one of the companies in Dubai, or one of the companies in the United States, obviously before doing the business or before approaching and all, you will try to look at the financial statements, and you will try to look at the, like, by looking at the financial statements, you will be, or you will try to analyze the overall business size and the working of the business now. I mean, same case, you need to place an order of 1.5 million dollars to me, and my whole business has a net assets, or my whole business is for like around 200,000. My investment in the whole business for 200,000 only. I have little and small assets. How is it possible for me to deliver you the order of 1.5 million? I mean, I don't have this much of the scale or this much big machinery to deliver you this much big, big size order, right? Try to understand the point. Done. Similarly, if somebody tries to, or some company tries to approach to you for the credit or something, obviously you will have to evaluate, like, if I give them on the credit, will they be able to pay me or not? That's something which is required as well, right? So that is why we need to go for the summarized form so that it is easier for us to understand. And then we need to follow the accounting standard so that the information which is presented or which is shown is something which is at least understandable by all. At least that is something which is understandable by all, right? Because if you give in a standard format now, so that standard format is something almost everyone knows, at least from a bit of the financial background now, or the financial knowledge or the accounting knowledge. Almost everyone knows how to read. So technically, that is something which is going to be easier for you to understand, right? Now, when we talk about the management accounting, now that is used for in-house and that is into the detailed analysis, like, you know, like for example, we say now that we had this much of a sale for the year, which costed this amount, and this is our profit. In the management accounting, you talk about that if you had the sales of this figure, XYZ figure, why you had the sales of this figure. I mean, why not extra or why not less? Say, in case you had a sales of 1500 for the year, why not 1600? Why not 1400? I mean, do you have any specific pattern for the profit percentages that you have at the end of the day? Right? Or if the cost of a product is like around 1000, why it is 1000? Why not something else? Or what is the breakup of this 1000 cost? You are going to break down the product into the parts, into the material, into the labor, into the expenses, and then you are going to see and analyze that how the total cost and what is the composition of the total cost that is being made up, right? This is what the detailed analysis is, right? They go into the detail, and then there's no specific pattern. The information can be according to the requirement of the line manager. Like, for example, your manager asks you to bring him or her the report of the quarter sales or quarterly sales of the item ABC, right? For the item ABC, which you recently launched in the new city, right? Which you have recently launched in the new city. So you have to get that information and all, right? So this is what your line manager is asking. But in the financial accounting, we don't go into these details. We just simply say, yeah, these are the total sales for the year. This is the cost and this is the profit. That's it, right? Then financial accounting is something which is required by law, right? Financial accounting is something which is required by law, that at least you are required to prepare the accounts annually, so that the user of the financial statements or the shareholder in a company at least get to know that what is happening, because this is your amount, this is your finance, this is your money, which the directors of the management is playing with and generating the returns for you. So at least on an annual basis, they need to know that what is happening, right? So that is why, according to the Companies Act, the financial account, the final accounts, they are at least required uh, by law on an annual basis at least, right? Then the financial accounting, the biggest inherent limitation of the financial accounting is that it reflects the past performance, the past financial position. It's all about the past records. It's not about the future, right? It's not even about to some extent, yes, it's current, but not the current properly. I mean, when it comes towards the performance is always past, right? You report at the end of the day that what have been your total sales for the day. You report at the end of the day that what has been your cost. You report at the end of the day that what have been your expenses. You report at the end of the day that what have been your profit. I'm stressing on the point end of the day, end of the time, after the period has passed, right? This is the biggest inherent limitation of the financial accounting, right? For example, this is the new year now. We are onto the 17th January, right? So at this time, basically on full throttle, the accounts for the companies are being prepared, accounts for the businesses are being prepared, which have an year end of the 31st December, right? By the end of the January or mid of February, the accounts are going to be published and they are going to be out, and then we all are going to know that what has been earned, what is the profit, what is the loss for the business for the year ended 31st December 2024. So after the whole year has passed, after that you are going to know, after that you are going to know that what the business has earned, what the business has lost, where the business is actually standing in that particular time period, in that particular year, right? So that is the information that you are getting after the period, right? So this is the biggest inherent limitation. So the management accounting, on the other hand, it reflects the past performance, right? But we have the forecast, we have the budgets as well, right? And we do the forecasting over there as well. But again, the budgets or the forecasting, they cannot ensure the future performance. Similarly, even the financial accounting as well, it does not ensure the future performance. You can predict the performance on the basis of the past practice or on the basis of what you have done earlier. You can predict, but you cannot guarantee it. That is for sure. I mean, say in case if the company has earned a profit of like around 1 million in the year, you can predict about, if everything goes correct, if everything goes right, you'll end up getting the profit of 1 million again in the year. This is what you can predict to some extent. But if dramatically the operations fails or something, you might get a loss. There is a chance, right? You cannot guarantee that you will going to have the profit or something. That you cannot give the guarantee to that, right? So this is what basically the major difference between the financial accounting and the management accounting is, that they go into the very basics, very details, into very detailed analysis. Such analysis are not required over here in the financial accounting. We have to talk about straight away by following the accounting standards like anything, right? And these are strictly followed over here, right? Because if we don't follow the strictly accounting standards, then obviously we cannot rely on to the financial statements as well. We cannot rely on to the accounts as well. So primarily following the accounting standards is the prerequisite over here, And we are going to learn the accounting standards over here. We are going to learn the basics over here, why which on the basis of which then we are going to move forward. Okay. Now, let's just talk about again accounting. It is the recording, summarizing, and presentation. Accounting is the recording, summarizing, and presentation. When we write the word financial before the accounting, it is the recording, summarizing, and presentation of financial transactions, right? Now, this financial transactions, if I talk about this one over here, what is a transaction? Anyone? What's a transaction? Anyone knows what's a transaction? Come on, anyone?
A transaction is one that has a dual effect.
A transaction is something which is going to have a dual effect. Okay, agreed upon. Anybody else? Anyone? I'm a layman. I don't want to have the answer within the or with the context of the accounting. It's just a basic thing in the basic simple words. Okay, let me help you. Transaction is I can say when property changes hand to hand or when exchange of interest occurs, right? When property changes hand to hand, when exchange of interest occurs, it's called a transaction. Like, for example, I am speaking, you are listening. I'm giving the lecture, you are taking the lecture, right? I'm explaining you, you are understanding. This is a transaction, right? When exchange of interest occur, why are you here? Why am I here? You guys are over here to study, right? You guys are over here to study now. That is why you guys are here now. And I am over here not for teaching, but to earn money. Right? I'm over here to earn the money, right? Or you can say I'm over here, okay, let's just get something like, ideally speaking, I'm over here to teach you guys, right? So this one arrangement where you guys are sitting over there, I am sitting over here, but the arrangement is that we have on this very or via this very class, same class, you are studying and I'm teaching, right? So that is what the exchange of interest is, right? Then we have types of transactions. Types of transaction, we have a cash transaction, we have a credit transaction. Cash transaction. Cash transaction is where the cash is involved on the spot. Like, for example, uh buying anything for cash. First we talked about this transaction, that is the when property changes hand to hand or when exchange of interest occurs, it's called a transaction. Then we talked about the types of transaction. The types of transaction we talked about, we have a cash transaction and we have a credit transaction as well. So a cash transaction is the one in which the cash is involved on the spot. Credit transaction is the one where the cash is involved at some later stage, right? Like for example, when you buy the goods on credit or something, right? That is called as the credit transaction. Like for example, you go to the petrol station, right? You fill up your car's tank and you pay the money. That is a cash transaction. You go to the grocery store, you buy the grocery, you pay the bill via the credit card or via the debit card. That is going to be a cash transaction because you straight away settled the store's account, right? That is a cash transaction where the cash is involved on the spot. Now, the credit transaction is you buy the goods from your supplier and you promise him to pay tomorrow or a day after tomorrow or after a week. So you got the goods, but you haven't paid for it. That's a credit transaction. You wanted to buy a mobile, your friend was selling the mobile, you got the cell phone from your friend, and you promised him that you will pay him as soon as you get the salary. Your friend gave you the cell phone, right? That is a credit transaction because you got the phone, but you have to pay for it. That's a credit transaction, right? Similarly, um, you know, you are enjoying the electricity, right? You are consuming the electricity. After the month, when you have consumed it, you will get the bill, right? Now you have to pay the bill. That is a credit transaction. Done. So the cash transaction is where the cash is involved on the spot. The credit transaction is where the cash is involved at some later stage. Done. Then we have outcome of transaction. Outcome of transaction is asset, expense, income, liability, and capital. You take up the transaction of the whole world. You take up the transaction of the whole world. You try to assess the transaction of the whole world. At the end of the day, the outcome of all of the transactions that we have, they are either going to be the asset, expense, income, liability, or capital. You take up the transaction of the whole world. Eventually and finally, the outcome is going to be either asset, expense, income, liability, or capital. Nothing more. And there can never ever be a sixth outcome. You try, I mean, bring up the sixth outcome if you think that there's something or something, right? There can never ever be, right? Now, the first one is asset. Asset is what we own. In layman term, it's called as what we own. And in definition terms, we say that when it is probable that economic benefit will flow towards the organization, it's called an asset. When it is probable that economic benefit will flow towards the organization, it's called an asset. Probable means more than 75%. When you are more than 75% confirm that you are going to get an economic benefit, you are going to get a benefit which is going to be, evaluated in terms of the monetary value or something, right? That is called as, this is a full screen. I need to have a full screen. Okay. Yeah. So when it is probable that economic benefit will flow towards the organization, you are more than 75% confirmed that you are going to get an economic benefit that can be evaluated in terms of money. The benefit that can be evaluated in terms of money, right? You are going to have something, it's called an asset, right? For example, land, building, car, bike, etc. Right? These are your assets. Now, we have two types of asset. One is called as non-current asset. Non-current asset is the asset whose benefit is for more than 12 months. Non-current asset is the asset whose benefit is for more than 12 months. For example, land, building, car, bike, laptop, mobile, etc. Right? So these are the types of non-current assets. Then the current assets are the assets whose benefit is for less than equal to 12 months. Whose benefit is for less than equal to 12 months. Like, for example, we have cash, we have all the variable items, I mean, the clothes and etc. Right? And then we can also have the party or a person. We can also have the party or person or the customer to whom we have sold goods on credit, right? From whom we have to receive the cash, we have to receive the money. That person is also going to be called as your current asset as well, right? So the non-current assets are the assets whose benefit is for more than 12 months, and current assets are the assets whose benefit is for less than equal to 12 months, right? Now, just for the sake of understanding and all, Miss Amira, please kindly unmute yourself and tell me about one of your assets. One of your assets. Come on, hurry up.
My mobile.
Okay, I've already mentioned the mobile. Please tell me any asset which is not written over here. For example, land, building, car, bike, mobile, laptop, right? These are the ones which I have written over here. Tell me something about other than this.
TV.
What?
My TV.
Yes, exactly. Very good. Very good. Absolutely right. Absolutely right. Correct. Thank you. Mihir, it's your turn.
Table,
Table, agreed upon, agreed upon. Very good. Ms. Pagwa, Ms.
property,
Pag, what?
property,
Property? Ms. Pagwa, actually, your voice just broke. You said property. Please unmute yourself.
yes,
Okay. Do you own a property? First, tell me this thing. Do you have your own property?
no,
Then it's not your asset. Tell me something that is yours. Come on, try to think about it. Try to think outside the box. Come on. This is something I need to have it from you guys.
computer,
Miss yeah, what?
computer,
Computer is already done with the laptop. It's already done. Something else. Something else. Come on. Think about.
furniture,
Table is done. Table is done. The furniture. Something more else. What else? Miss Pagwa, I've normally seen even ladies at my home as well. You all have lots of handbags, right? So do you have any handbag?
yes,
That's yours?
yes,
You own it?
yes,
So that's your asset, right?
right,
Don't go from the accounting perspective only that if something is over there in the accounting, then that is going to be my asset or something, right? Don't go with that. Umi, it's your turn. Come on. Things are getting complex now. Tell me an asset. Tell me your asset.
Right now, I have only a set of laptop.
But laptop is already mentioned over here.
Yeah,
Come on, think about. Look around the place where you're sitting. Look around and think about an asset that you own. Do
There's
you have any? What?
perfumes. Perfumes.
Yes. 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 Very good. Very good. Very good. It's your asset. Done. Very good. Kunal, it's your turn.
Appreciation.
Ah, see, very good, very good. You were on the toes and waiting for your turn to come to straight away tell that your PlayStation is your asset. Very good. See, this is what I need. Okay, I mean, in order to understand the accounting, we don't have to go into the complex examples. Just look around. I mean, like in your room, the bed, your mattress, the pillow covers, the sheets, the AC, even the teddy bear to whom you hug during the night, right? They all are your assets. They all are your assets, right? The furniture that you have at your place or something, even your parents, your siblings, they are your assets, right? And if you are like somebody, what should I call, like the particular name, somebody innocent, or somebody like not the innocent something, I'm just like feeling myself short of word, the innocent poor guy like me who is married, so that my spouse is my asset as well, right? Try to understand what I want to say over here, right? So poor us, like our spouse is our asset as well. They're the biological assets. Our parents are our assets, right? Our like siblings, they are our assets as well. See, these are the biological assets. I mean, if I even want to count it from the accounting point of view. Done. uh our knowledge, our experience, our like thoughts, our like experiences that we get, these all are our assets. We don't have to go into the accounting, right? I mean, if you are good at something, your skills that you have, they are your assets. I'm not talking about are they going to be there or not, can we record them or not. I'm not talking about in this context. Same case, you have a pen over there, you have a register over there, you have a school bag, you have the books with you, right? They all are your assets, your shades, your watches, like that you have. They all are your assets, okay? We don't have to go into the accounting in order to understand that what is an asset or what is not an asset, okay? I'm not going to get like ever like create complexity in order to understand. We have so much of the accounting around us that this is something easily understandable. Now, you guys must have seen the Matrix movie, right? I'm sure about this, that after today's class, when you going when you gonna go up and go out, like from your seat outside, the matrix is gonna work, and you will see around that this is asset, this is not an asset, this is asset, this is not an asset, and everything, right? So this is going to happen. Let's just move forward now. From the asset, let's just talk about the expense. Expense means like, when you consume something, and that is the expiration of economic benefit is called an expense. Expiration of economic benefit is called an expense. Now, when we get an economic benefit, when we have an inflow of economic benefit, that is an asset. When that same very economic benefit expires, it's an expense. I'm repeating myself. When we get an economic benefit, that is an asset, right? When it's probable, we are going to get a benefit, economic benefit, or a monetary value benefit, that is going to be called as an asset. And then same very economic benefit, when it expires, when the same very economic benefit expires, it's called an expense. What does it mean? How is it going to expire? Or how we can understand it up? Now, I told you earlier, you go to the petrol station, you give the cash, you get the petrol in the car. That is an exchange of asset. At this moment, there is no expense. At this moment, this is simply an exchange of asset. You gave the cash, you got the petrol, right? You gave the cash, you got the petrol. This is simple exchange of asset. Now, you start your car, you put it into the gear, and you put down the handbrake, you start moving. Engine is running, it's consuming the petrol and it's moving. See, you are consuming the petrol and you are moving. You are consuming the petrol and you are moving, right? As you move, as the petrol consumes, you move. As you get the benefit of moving, the petrol expires. The petrol finishes. It burns off, right? So as it is running, as it is burning off, as you are traveling, simultaneously it's giving you the benefit and it's expiring. It's giving you the benefit, it's expiring, right? Put the petrol on side. We are thirsty. We go to a shop, we give the money, we buy a water bottle. We open the bottle, we take 2 4 sips, right? And we end up sipping, or we end up drinking half the bottle. Now, say in case the bottle was for like around 10 rupees, half empty, we have we drank the 5 rupees water out of it. That is finished. That is expense. The 5 is left. The 5 rupee asset is still left. As we sip again, we consume it again. Right? So that is what the relation of the asset and the expenses. Right? As soon as it gives a benefit, it expires. Like, for example, you have the carriers over there for the mobile phone, and you must have some prepaid connections as well. Now, what happens in the prepaid? You take the carrier phones, scratch cards, or they must have some load options via the banks or something, or the banking application or something, right? So you get an easy load, or you get a scratch card of 500 rupees, right? You get the 500 rupees card for your mobile. Done. You gave the money to the carrier company and you got the equivalent balance or the credit against the 500 rupees. This is an exchange of asset. Done. Whenever you want to make a call, whenever you want to send a message, whenever you want to have the 4G internet or something, or 5G internet or something, right? It is going to consume your money which you have loaded in the account. Done. It will keep on working till the balance is there, because when you are on the call is connected, it's going, it's running. At the same time, the bill is being charged to you. After a while, when the balance is finished, when the balance is finished, right, and you try to make another call, the lady on the other end with a beautiful voice will say that you don't have enough money, or you don't have sufficient funds to make the call. So please go, load, and then come back, right? That is what the lady, normally says over here to us as well, right? When we are out of balance, she literally, just say to us that lay off, go get the balance, and then come back, right? So that is the relation of the expense and the relation of the asset over here, right? That the asset or the economic benefit, it's going to give you the benefit and then it expires, right? Now, types of expenses. We have a capital expenditure. Capital expenditure is when you buy a non-current asset. It's called a capital expenditure, right? When you spend on your non-current asset in such a way that its performance is enhanced, right? Or you spend on your non-current assets on a non-current asset in such a way that the useful life is increased as well, right? The capital expenditure are when you buy a non-current asset, it's a capital expenditure. You spend on your non-current asset in such a way that its performance is enhanced, that is a capital expenditure. You spend on your non-current asset in such a way that its useful life is increased or something, that is a capital expenditure. Done. Like, for example, Kunal, what's your favorite car? Kunal, I need to know about your favorite car.
It's Toyota.
Toyota what? Which one?
Fortuner.
Fortuner. Okay. So, Kunal likes Toyota Fortuner, the SUV, right? Now,
Yeah.
he buys. So, Kunal, you buy a brand new Toyota Fortuner, right? Or you buy a second-hand Fortuner, whatever, right? It doesn't matter if it's a brand new or it's a second-hand. When you buy it first time, that's going to be a non-current asset, right? So, it's going to be a capital expenditure. Done. Now, Kunal is kind of like, a racing type guy. I mean, but somehow, somewhere he will be able to do some racing on the SUVs as well. Now, Kunal goes to the the car auto store and he buys the HID lights from there. The normal lights in the car, they like give you the visual of around like 500 meters or 0.5 kilometer or 500 meters at night, but he decides to install the HID lights in the car, which is going to help him see up to 1.5 kilometers. First you were able to see only 500 meters, but with the HID install, you will be able to see up to 1.5 kilometer, right? So obviously, this is an upgradation. This is where the performance of the car is being enhanced, right? It's going to be a capital expenditure. Similarly, Kunal is good at driving, but he doesn't trust the other people on the road driving. So what he do is he installs the safety grille right in front and the back of the car as well. So the safety grille is there to protect the car from the impacts or from the accidents, right? Performance is enhanced, capital expenditure. Kunal is a VVIP person, so he decides to install the bulletproof mirrors in the car or the bulletproof screens in the car, right? Now, obviously, with the bulletproof, the screens and all, that is, or the bulletproof glass is going to be enhanced performance in terms of the protection and all, capital expenditure, right? So, whatever expense you do on the car, you have to evaluate either it's going to enhance its performance or not. Now, after driving for like around 3 years or so, right? The car's tires, they are worn out. Now he goes to the shop and he buys the brand new tires. And the tires he had earlier of whatever ABC company, they were really very good. So he decides to buy the same tires because they have been really very good in terms of the road grip and everything. Like, it rains quite a lot over there in the Mauritius as well. Huh? So they have been really very good in the rain as well. And he had a very good road grip as well for the tires, right? So he goes over there and he buys the brand new tires. Now, what is this expense going to be? My question. Anyone? Anyone who wants to answer can. What is this sort of expense going to be? He's buying the brand new tires because every now and then his tires are getting punctured. So he decides to buy the brand new car. Yes, Kunal.
Useful life increased.
How?
Because after using the tires for 3 years, I changed it and now I can use it for more 3 years.
Okay. So you mean to say that they should be capitalized, right?
Yeah.
Okay, done. I got your answer. Somebody else? Anyone else? Come on, guys. Be on the toes. Miss Amira. Mihir. I need to have an input.
Capital expenditure.
What?
Capital expenditure because it increases useful life.
Okay, thank you. I got your answer as well. Now, uh, he got the new tires, right? as let's assume this is the level of the performance of the car on the day one with the new tires, with the new everything, right? With the passage of time, this is the car over here with this level. With the passage of time, the cars, they got like, worn out. So gradually the performance went down, right? Now, when he's going to get the new tires, the performance is going to be back on the same level where it was 3 years ago. It will be on the same level again. The performance is not enhanced. It's on the same level it was before or at the start of the 3 years or at the second year or the first year. The performance is not enhanced. It's on the same level. It's maintained. This is going to be a revenue expenditure or revenue expense, because this is repair and maintenance. This is repair and maintenance. Repair and maintenance, you have to see the maintenance. Okay. Maintenance is something that is going to identify and help you see that either you on the same level or the performance is enhanced. This is what you have to evaluate. Like, for example, like the way we change the engine oil, the oil filter, the air filter, the cabin filter after every 5,000 to 6,000 kilometers. Nah? Why do we do that? So that the engine's health is maintained, right? So they are the revenue expenditure. Similarly, if you are changing something and the performance is going to be on the same level, it's going to be a revenue expenditure. Like, for example, Kunal got the new lights. Now, the electrician was something genius like me who ended up like, doing a bit of a wrong connection or something, that after 4 or 5 days, he had some electrical issue with the wiring and the new HID bulbs, they got fused, right? So Kunal went to a better electrician this time who identified the problem, rectified the problem, but it costed the Kunal to buy the new HID lights because old ones were fused and they could not be repaired or something. He got the same capacity. It doesn't matter even if the different brand, but he got the same capacity HID lights, which are going to help him to see up to 1.5 kilometer at night time, right? So this performance is maintained. It's not enhanced. So it's going to be a revenue expenditure. In order for an expenditure to be a capital expenditure, you simply have to evaluate, no matter how big or how small the expenses, you have to see either it's going to enhance the performance or not, either it's going to increase the useful life or not, right? Now, he got the PPF on the car, the paint protection film. I mean, this is kind of like, really very common over here, and it's getting literally very common over here in Pakistan as well. Like, the people, what they do is they buy the brand new cars and they straight away go to the PPF centers and they get
Ceramic
this.
coating.
Yeah, the coating. Yeah, the plastic, the wrapping coating, basically, like, one is a ceramic coating, that is something else. The PPF is, it's a kind of sort of a transparent film, right? The way we do the window tinting na, with the paper, that is this is that sort of a thing, that they apply the transparent sheet on the whole metallic body of the car. Why that? What happens is your car is safe from the scratches, right? The normal scratches which we normally get from our car, and even the car is same from the, like, small or little accidents that normally we do. Like, for example, I remember like around 3 or 4 days ago, while parking my car inside the house, I mean, I had to do the parallel parking with the other car as well. So what I did, I like, ended up like, turning my steering a bit extra towards the left side. So what happened? My front bumper from the side, it had a scratched, it got the regression with the wall on the side now. So it got some scratches on the, like, the paint and all. Now, if it would have had been the PPF on it, the PPF bears or it like bears the regression impact basically, right? And it doesn't let the paint to get scratched or something. So that is a PPF. Now, if you get the PPF installed, or you get the ceramic coating on the car for the first time, which is going to basically increase the useful life of the car now, because of the paint is not scratched, the metallic from the underside or the metal is not gonna be exposed to the humid, or the it's not gonna be exposed to the corrosion or something, right? Or it's not gonna get some rust or something. So obviously the body's life is gonna increase, right? So this is that sort of an expense. First time, it's gonna be capitalized. Second time, after 4 years, 3 years, or whatever the time period, you again redo the PPF. That time, if it's of the same quality, the way you had before or something, it's going to be a revenue expenditure, not capital for the second time. First time, if something is getting add on in your car or something, that is a capital. Second time, it's a revenue, right? I hope it's clear. I mean, if any one of you have any question or something, you can ask me. Otherwise, we are good to go. Done? Okay. Uh, okay, let's have a break of like maximum around 5-7 minutes, right? Let's just get up from our seats. I'm tired a bit as well. Walk around a bit. Don't sit here. Walk around a bit, stretch your legs, then come back, and after 5-7 minutes, we are going to resume. Okay, let's have a break. Okay, I'm back. So let's resume now. So we were talking about the expense over here. Now moving ahead from here, let's just talk about the income. Income is something we say that earned economic benefit is called an income. Now, the economic benefit which you are going to earn is called income. For example, your salary. For example, if you have rented out a place and you are receiving the rent, for example, you have some sort of a profit on anything that you sell or something on which you get the profit, so that's called as the income over here, right? So earned economic benefit is what you have, the income. So now, when we had the probability of getting that economic benefit, that was asset. When that economic benefit expired, it's expense. And when that same very economic benefit we earned, that is income, right? Then after the income, we have another term called as the liability. Liability is what we owe. That is, whatever we owe, whatever is our responsibility, that is going to be called as a liability. And the standard definition is a present obligation arising from some past event, the settlement of which will result in an outflow of economic benefit from the organization, right? So a present obligation arising from some past event, the settlement of which will result in an outflow of economic benefit from the organization. That is what we call as a liability, right? So it's a present obligation that we have. Like, for example, we can say it can be a loan, it can be a short-term loan, and it can be the amount that you have to pay to your supplier for the goods that you bought from him, As far as the liability is concerned, we have two types of liabilities. One is called as the non-current liabilities. They are the ones which are settled for in more than 12 months. For example, long-term loans, leases, and mortgage, right? Let's write lease, and this is a long-term loan. Similarly, we can have a current liability as well. That is which settles in less than equal to 12 months. Like, for example, your short-term loan, or you can have the bank overdraft. You can have the creditors over here. They are also called as the payables. Creditor is the person or the supplier to whom you have to do the payment for the goods that you have bought. Anything from a person, any person from whom you buy on credit, that person is called as a creditor or a payable. Okay? Any person or any company or any business from whom you buy on credit, that party or person is called as a creditor or a payable. Short-term loan, you have taken a loan for around 1, 2, 3, 4, 5, 6 months. That's going to be settled within the 12 months. Bank overdraft is a facility that is being given to normally the business accounts by the bank, where they can have a negative balance, right? Negative balance means saying is I have a business account and I have taken this facility from the bank. I have like around 60,000 in my account, but I have given a check to one of my suppliers for 70,000. Now, when the supplier is going to take that check into the bank is going to deduct the 60 from my account, and then the bank is going to pay the customer 10,000 from its own pocket. The bank will pay the supplier on my behalf. So the 70 payment is done. And my account's balance will be shown as negative 10,000. My account's balance is going to be shown as a negative 10,000, right? Now, what will happen whenever I am going to get the balance in my account again? The bank will deduct that 10,000 from my account, plus it will deduct a nominal fee, which is over there against the arrangement of this negative balance. The bank is going to charge me a fee against that as well, right? So obviously, if I've taken the money from the bank, I have to repay it, na? Repay the bank. So that is a my liability over here. And normally the bank overdrafts, they are the facilities for the shorter term, basically for the less than 12 months, right? So this is what the current and the non-current liabilities are. Now, if we look at the balance, if we look at the definition over here of the liability, it states a present obligation arising from some past event, the settlement of which will result in an outflow of economic benefit. Now, that same very economic benefit is having an outflow, so that is a liability over here. Then we have capital. Capital is invested economic benefits by the owner of the business is called capital. Now, those same very economic benefits, if they are invested by the owner of the business, they are called a capital. For example, rent a car, rent a bike, or cash, etc. Like, for example, you have multiple cars, you start off the business of, the rent a car, or you start some business of the Uber or the any other, what do we call it as the taxi service or something. Yeah, you start a business with that for renting out. Similarly, you have you have a house and you start off the business with that. That's going to be your capital. You have the money, you start the business with that. That is the the capital and all that we have, right? Then we have a thing called as movement in capital. Now we have a thing called as movement in capital. At the period start, we are going to have opening capital. In that, I'm extending my business, or I have a business extension. I introduce more capital. That will be added over here. Similarly, if I get a profit, that will be added over here. Similarly, if I get a loss, that will be deducted from here. Similarly, if I have some expenses or something, they will be deducted from here. Similarly, if I have some drawings or something, they will be deducted from here, right? And then at the end of the day, or at the end of the period, I am going to have my closing capital, right? Now, with this, I have the word drawings. Drawings are when the owner takes the money or the goods out of business for personal use without paying for it. It's called drawings. When the owner takes out the money or the goods from the business without paying for it, it's called drawings. For example, I run a toy store. I run a toy store. I take out some toys for my kids, right? I bring home some toys from my shop for my kids, and obviously I didn't pay anything into the till, right? So the value of the toys, the cost of the toys, they are going to be considered as my drawings. Similarly, I take out some bucks for my own use, for my personal use, from the cash till of the business. So the amount of the cash that I've taken out, that's going to be called as drawings, right? So this is what we have, overall speaking, the movement of as far as the drawings are concerned, right? Okay, now moving ahead from here, we have one more thing over here, and that is called as a duality concept. A duality concept is every transaction will always have at least two outcomes. Every transaction will always have at least two outcomes, right? Now, let's just take a transaction. Mr. A started business with $10,000. Mr. A started business with $10,000. Now, if I talk about this 10,000, this is the amount, or this 10,000 is cash, right? Cash is my asset, right? One effect. Secondly, with this amount, I have started my business, right? So this is my investment. This is my capital. So this very 10,000, which I have started the business with, this is my capital. This is the cash. This is the asset as well, right? So this is what basically the duality concept is, right? Now, moving ahead, I have another concept which we need to talk about, and that is accounting equation over here. Accounting equation is the equation that we have, that is assets is equal to capital plus liabilities, right? The accounting equation is assets is equal to capital plus liabilities, right? Now, for example, we have a transaction number one, like Mr. A started business with $10,000. The same very transaction we looked over here. Now, if I try to put in into the accounting equation over here, if I try to put it into the accounting equation over here, how is it going to work? Cash 10,000 is equal to capital plus liabilities. So 10,000 is equal to 10,000. The duality concept, because this business started, this is the amount of cash. So cash is the asset. Similarly, this is the amount with which the business has been started. So this is my capital. So I can write 10,000 cash, my asset, is equal to my capital 10,000, right? All of the recording in accounting is based upon the principles of duality concept. Every transaction in the universe is going to have a dual effect, right? Like the way Kunal said earlier when I asked about that, what's a transaction? The Kunal said at that time, anything that has a dual effect, that's a transaction, right? So this is what he was talking about, and he was right. I mean, if we look from the perspective, the outcome of the transaction, or we see the effect of the transaction, that is what the dual is, right? So this is what now we have to talk about. So Mr. A, he started business with $10,000, and the entry is going to be cash 10,000 is equal to capital 10,000 over here, right? Now let's just take a look at another one. He purchased balloons for 2,000. Carriage card 1,500 and a gas cylinder 500 for cash. Now what he did with the $10,000, he has started the business of selling the balloons, like the gas balloons that we have, right? So he's starting that business. So what he did, he purchased the balloons for 2,000, a carriage card for 1,500 and a gas cylinder for 500 on cash, for cash. So what will happen? New assets are gonna be created over here. The balloon which he's getting for the resale purposes, the carriage card which he will move around with, and the gas cylinder with which he will be filling up the balloons. So new assets are created over here, and the existing cash asset or existing asset, the cash, it's decreasing and the new assets are increasing. So dual effect is over here. Like for example, balloons we have over here plus carriage card plus gas cylinder, right? Plus cash is equal to capital plus liabilities. I'll write the capital right over here as well. Okay. Right? So I can write it like this. Now, balloons are for 2,000. Carriage card is for 1,500. Gas cylinder is for 500 plus cash. I already had 10,000 minus 2, 3.5, and 4. Right? Is equal to 10,000, the capital plus liability 0. Right? So this is how capital 10,000 is equal to, this is 6,000 over here. If I go over here, this is 6,000 remaining. So 6,000 plus 500, 6,500, 7, 8, 9, 10. So 10,000 is equal to 10,000 over here, right? Done. So at the end of the day, after every transaction, the accounting equation will remain balanced. It will remain balanced, right? Now, next, he sold all the balloons for cash 4,000. He sold all the balloons for 4,000 cash. Now, what is going to be the effect over here of this transaction? These 2,000 balloons, They are sold for 4,000. So first effect is the balloon's gone. Second effect is we got the cash. Now we have a third effect as well. And that is 2,000 balloons sold for 4,000. We have a profit element over here as well. Right? So third effect is going to be of the profit. So as far as the duality concept is concerned, it was every transaction will have at least two outcomes, not the maximum two outcomes. Right? At least two. There can be more than two. Like we have over here, the third one, that is a profit, right? Now, if I want to show it over here, how will I? Balloons, nil. Carriage cart, 1,500. Gas cylinder, 500. Cash, 6,000. Plus, now, 4,000. Right? And that is going to be 10,000. Is equal to, now, capital was earlier 10,000. It was earlier 10,000 plus 2,000, the profit element. This is the profit element as well, nah? So this is going to be 10,000 capital plus 2,000 profit plus liability, 0 over here. Right? So now if we look over here, as far as the accounting equation is concerned, we can see 10 plus 2 is 12,000 is equal to 10, 10 and a half, and then 12,000 over here. So 12,000 is equal to 12,000 over here. Done? Then, now let's have the fourth over here, and that is, he took 1,500 for his personal use. Now, he took 1,500 of the cash or $1,500 for his personal use over here. So the amount that we have, or he has, Mr. A has taken out is going to be called as drawings, right? Now, if we want to show the duality effect of the drawings, how it can be, we will, if we see the effect, how is it going to be? The cash is going to drop, the capital is going to drop because we minus the drawings from the capital. We have taken out the money, so the cash will decrease as well. Now, if I have to show it, how it will be done? Let's copy this up. Here we go. We don't have balloons. Okay, let's just copy this one as well. I mean, we can obviously, amend this up. We don't have the balloon, the carriage card, the gas cylinder is as gonna be over here. Okay, then let's just amend this up. Let's just amend this up as well. Now, the cash over here, this is 10,000 minus 1,500, 1.5K, right? And then, okay. Now, this was 12,000 capital minus 1,500 minus drawings, right? So look over here. 12,000 minus 1,500, 10,500. 10,500 is equal to 10 minus 1.5 is 8.5, 9, 10 and a half. So 10 and a half is equal to 10 and a half, right? Clear? This is clear to us, right? Now, moving ahead. Here we go. Now, let's see another one. He purchased further balloons for 2,000, this time on credit. Now, he purchased further balloons for $2,000, but this time on credit, right? So if we have to show this one, what is going to happen? We already have this line with us, so let's just copy and see its effect. Now we again have the balloons for 2000, and the remaining cash is gonna be over here. 10 minus 1.5 is 80. 500 over here. Similarly, we are only having the capital now. And this is what? 10,500? And now, because we got the balloons on credit now, so we are going to have a liability of 2,000 over here. So 10,500 plus 2,000 for the liabilities, because we got on the credit now. So 10,500 plus 2,000 is going to be 12,500. That is equal to 8.5, 9, 10 and a half, 12 and a half. So 12 and a half is equal to 12 and a half over here. Now, okay, let's just blow it up. Here we go. Now, number 6. He sold half of the balloons for 1,500 on credit. Now, he has sold half of the balloons for 1,500, but this time on credit. So technically, if he has sold the balloons on credit to somebody, so it means he has to get the money from him. So if it's probable that he's going to get the money, he's going to get the economic benefit. So the person to whom he has sold, he is going to be his asset over here. Now, let's go for the recording. Okay. Now, half of the balloons are sold, so technically we are going to be left with 1,000 only. Over here with the cash, we are going to plus over here the customer as the debtor. I'm writing the debtor over here, right? So the debtor I've sold for 1,500, so I have to get the 1,500. I'll add the 1,500 over here, right? Then if we look at the capital over here, with the capital, we are going to add the profit element. We have to add the profit element with this, right? And let me just put up a space. Okay. Now, the profit element, 1,000 balloon sold for 1,500, meaning we have a profit of 500 over here. So capital 10,500 plus 500 for the profit as well, right? So look, 11,000 plus 2 is 13,000 is equal to 8.5, 9, 10, 10.5, 11, 12, and 13. So 13,000 is equal to 13,000. You must have noticed something. Don't worry. I mean, if it's getting overwhelming or something, just relax. Obviously, when you're going to re-revise it, it will be clear to you. Just keep this one thing in mind. After every transaction, the accounting equation must be balanced and will always balance. If after any transaction, the accounting equation is not balanced or something, or the left-hand side is not equal to the right-hand side, so what does it mean? It means there is a problem or there is an error, which you have to obviously see and rectify, right? Then, point number 7, he paid off his liability in full. Now, he paid off his liability in full. That is, he was supposed to pay this 2,000, so he just paid this 2,000. So now what will happen? The cash is going to be at 6,500. The liabilities are going to be at 0 because we are going to minus it from the cash, right? And then 8 is he got 1,500 from his customer. Now, his customer paid him in full, right? Now, if this is the case, so we are going to eliminate the customer from here. 65, 7, and 8. This is gonna be 8,000 over here. We are going to eliminate this up, and this is going to be what? 10 and a half and 11. This is going to be 11,000 over here. And then this is going to be eliminated from here as well. Right? So 11,000 is equal to 8, 8 and a half, 9, 10, and 11. 11,000 is still equal to 11,000, right? So at the end of the day, remember one thing, that the accounting equation has to balance, right? Okay. I hope it's clear to you. Anyone has any question or something, please feel free to ask. Anyone, any question? Okay. Now, I am going to stop over here for the day. I don't have to rush. It's more than enough for what we have learned so far. And all I want you to is just go through, right, what we have learned. I mean, if you get the time tomorrow or whenever you do, just go through it again. Okay. I'm just waiting for the WhatsApp group to be created. And then obviously I am going to share you the latest book and the exam kits along with my notes as well. Right. So we are then going to talk about those once we have the WhatsApp group ready, because then I will show you and the notes and everything, and I will be sharing with you, and then I will be guiding you about the questions that you might have to do as a practice, during the home time and all, right? So I am going to stop now, and before we go and all, I want to have a bit of a feedback from you guys regarding today's class. That what do you think, or about the overall approach that we had for the class today? I mean, do you think is it fine, or should we change our approach a bit, or we should add something more, or anything that you guys want to add? I mean, I just want to have a bit of feedback from you guys. Yes, you can start one by one. Yes,
I
Kunal?
believe the class was a very interesting one because we had to learn various terminologies, and we used to find it on our financial statement, and it was like, this figure goes here, this figure goes here, without any logic doing it. Now I'm getting a better understanding of what's going as a non-current asset, what is a current asset, and also how we're going to treat a revenue expenditure and a capital expenditure. These were
Okay.
like itemized as big amounts should be allocated to capital expenditures, and amounts less than 500,000 should be closed as a repairs or maintenance costs. And now it's become more clear for me the approach to adopt while doing the accounting entries. For me, it's clearer, and the thing I already appreciated is more interaction, not the one-sided class where you're only talking and you're talking to a screen. It's very difficult to talk to a screen. Me, I'm used to it because we do meetings, we do everything, but talking to a screen without any response is like, well, I'm talking to myself or what's happening, and it's like a wake-up call for us as well. If we are following the class or we are just scrolling through TikToks or Facebook, for me it was very fruitful the first day, and I'm sure with time and with the notes we are going to have practice sessions live. We are going to do questions, and we can prompt you anytime we are getting any issue with the questions.
Yeah, definitely, definitely. Thank you so much for the detailed review and all and the feedback. Yes, you are absolutely right. This is something which I always require and ask, and I always request all of my students to do, to have a proper interaction, right? Because obviously, if I keep on talking and I don't involve you in the discussion and all, now what will happen? You guys are gonna get bored as well, because your attention span, you will you were right that you will start scrolling to the the social media and all, nah, apart from this, because obviously I cannot see you guys what you guys are doing over there, right? So I don't know. I mean, if you have a whole 100% of the concentration onto the screen and all, or if you're doing some other work or not, right? So obviously, by having the interaction, at least I get to know that you guys are over there listening to me, and you are with me over there in the class. So yes, this is gonna be a two-way traffic, and definitely for for sure, I am going to have this practice and all, right? Always. I understand at times, we are at certain places where, we have some background noise with us and all, na? And at times we feel like as if, if I unmute or I talk, there's gonna be some background noise more than my voice or something, na? So I understand. I mean, at home it does happen, but try to find a place where you are sitting and studying. I mean, you have a proper silence, or at least you have the earbuds or the hands free with you, that at least you are able to properly focus on to my voice about what I'm saying, right? And what we are studying. And then again, yes, you are right that I need to have the interaction from you guys, so that it can be a two-way traffic, and then we can easily understand and easily can discuss as well, because by discussion, rather than reading or listening now, via the discussion we can clear our concepts. Secondly, this is going to be my responsibility, where I will be covering around 80% of the exam kit of the BPP over here in the class. I'll be providing you with the Kaplan exam kit as well. But again, the Kaplan exam kit is something that you have to do on your own. At the same time, whenever you have a question from any source you have, apart from the Kaplan as well, you can always ask me. Just send me the screenshot and ask me the question. I'll be more than happy to assist you and guide you, right? The remaining 20% of of the BPP exam kit is something which I will kind of sort of dedicate you to do. Some questions in the class, some questions as a homework or as an assignment as well. It's just that what you have to do is, whenever I give you some assignment or a home task, try to send me beforehand. Like for example, if you have the class on the Fridays, now try to send me the work maximum by Wednesday or the Thursdays, because obviously I have other work, other classes as well. So I have to schedule, and I have to make up a plan as well, that at what time I'll be looking at the assignments that you have sent me, right? Because I have to identify your weak points in those assignments as well. And then obviously I will have to polish you as well, right? So keep this thing in mind, that whatever the work I give you, try to do. I understand that you guys are busy, the ones who are doing the job and all. Nah? I understand. I respect that. But still, you have to take out the time. That is when and how you guys are going to have the consistency, this is what I require. Now, anyone else who would like to add something? Like Miss Amira, you are over here. Any thoughts about the today's lecture? Miss Mahir, you are over here as well.
It was fine.
Okay, so that's it. It was fine, huh? Okay, okay, got your point. Got your point. Okay then. So it's time to say bye now. I'm going to be over here again with you guys, same time, same place, same channel, on the next Friday. Till then, you have to take care of yourself, your family, your friends, and the people around you. Okay. Have a lovely weekend, because that is going to be the best part of the week, where, if you are a jobian and you get an off somehow, some way on the Saturdays or the Sundays, that is the lovely time of the week. Unlike me, who has to work on the Saturdays and the Sundays as well. So enjoy that best time of the week. And then when you come again on the Friday, try to revise what we have learned today. Till then, take care. Bye bye.
Why, thank you very much.